Hello, everyone. Welcome to the ultimate guide to investing cash on the sidelines. I'm Charlie Bilello. Today, I'm going to run through everything you should be thinking about if you have cash sitting on the sidelines waiting to get investing. So this is a situation probably many of you will be familiar with. You have cash sitting on the sidelines, and this is cash that you don't expect to use for, let's say, 10 years, 20 years, a long period of time. It's cash sitting in a checking account or under your mattress or anywhere. It's just sitting there and you're waiting to invest it. And you know, you've seen the odds, you've seen the data, you know that over a long period of time, investing it in something other than cash is going to lead to higher returns over time and a higher ending balance. But you just can't pull the trigger. You're not at market timers. You're not thinking I could jump in and jump out of the market, but you have a number of concerns that are preventing you from investing that cash. Here is probably some of the things that you're thinking about. You're waiting for a big correction to get in, so you want to get in lower. You're worried about high valuations. You're worried about a potential recession next year and that hurting the stock market. And lastly, interest rates, always a concern, but interest rates have been going up over the past few years, and you're worried about higher interest rates and their impact on the stock market. So you're thinking about what to do with this cash, and you're really wondering, well, what does the data suggest? What does the evidence suggest historically about all of these questions? That's what we're going to talk about today. And I want to start by talking about the opportunity cost of sitting in cash. So you're sitting in cash, and there's a cost to that, and it's not always obvious what that is. And for the purpose of this video, I'm going to assume that you guys are real smart. You're going to go out and get the highest yield on cash that you can. A lot of times when people do these studies, they'll say cash is earning zero. And of course, you can get a much higher return than that on cash with minimal level of effort. So here, for the purpose of this video, I'm always going to assume when I say cash that we're talking about 3-month Treasury bills. And you can see over time, that yield on 3-month Treasury bills has varied over time from as low as pretty much zero to as high as 14%. And the average historically has been about 3%. So I just take that yield, whatever it is at the time. And for this purpose on the study, that's what I'm assuming is going to be in cash. So let's say you're sitting in cash today, or you're sitting in cash historically over the next year, over a 1-year period. What are the odds of that cash outperforming an investment in the stock market, the S&P 500 here, using as the stock market? Well, about 31%. So it's not zero. So 31% of the time historically, just sitting there in 3-month Treasury bills, you would have outperformed the S&P 500. So of course that means the S&P 500 sometimes is up less than what cash is giving you, or sometimes of course that it's down. But as you can see, as time goes on here, the odds of outperforming the S&P 500 by sitting in cash go way down here. And you can see over a 10-year period, only 15% of the time. And there's never been a 25 or 30-year period where sitting in cash has outperformed an investment in the stock market. And if we look at this in terms of underperformance, you can see in a 1-year period, it's not likely to be huge. Sometimes you'll actually see cash outperform the stock market like we saw in 2022 or we saw back in 2008. But usually there's some cost of sitting in cash, and the average on a 1-year period is about 8% underperformance. But you can see here that underperformance really increases exponentially with time. So over a 10-year period, the average cumulative underperformance is 158%, 20 years over 700%, and 30 years over 2,000% underperformance. And that likely probably doesn't mean very much to you. We don't think in terms of percentages. We think in terms of dollars. So let's say you started with a $100,000 portfolio and you either invested in cash, 3-month Treasury bills, or the S&P 500. Well, this is showing you what that would grow to on average over time. So over a 1-year period, not a huge difference. You're about 103,000 if you invest in 3-month Treasury bills, 111,000 if you invested in the stock market. But you can see the differential starts to grow here with time. When you go to 10 years, you're at 145,000 in terms of growth for 3-month Treasuries, over 300,000 for the stock market. And over real long periods of time, really compounding really helps the stock market way more. That higher level of return compounded over 30 years. You can see here over 2.5 million on average for the stock market versus a little bit less than 400,000 for 3-month treasury bills. Of course, none of this is assuming any taxes on that money. And if taxes were included, the advantage to the stock market would be even greater because you get more preferential treatment in terms of capital gains rate being lower than how 3-month treasury bills are being taxed, which is at ordinary income rates. Okay, number 2 here, waiting for a correction. So let's say you're saying, well, I want to get in at a lower price. Stocks are too high. There hasn't been a correction. I want to wait for a pullback to get in. What are the odds historically that you would be able to get in at a lower price than today? So I went back to 1928 and I looked at all of the data and what does it suggest in terms of would you be able to get in at a lower price? And most of the time, the answer is yes. So most of the time, if you wait, you'll get a monthly close in the future that's lower than where we are today, 75% of the time. The problem, of course, is in the red side of this chart here. 25% of the time, the market never looks back. It just keeps running. And when it does, that causes a lot of problems, of course, for people who are saying, I'm just going to wait for a lower close that doesn't come. Then you have a decision to make. And the best example of this historically are years like 1995, where the market runs up out of the gate and it never looks back. So let's say at the beginning of 1995, you're saying, okay, I'm waiting for a correction. I'm waiting for a 5% pullback, not a big pullback, just 5% to get into the market. By the end of February, the stock market's already up 6%. And the entire year in 1995, there wasn't a pullback greater than 2.5%. So when did that 5% pullback finally come? Not until July 1996. And when that pullback came, you were 25% higher than where you were at the end of February 1995. So if you're waiting for this pullback, it might come, but it might come at a much higher price than where you are today. And then that causes a question, well, what do you do then? Do you buy in at that higher price? Well, most of the time people would probably say no, because I'm going to wait for an even bigger correction, which brings us to the next question here. What if you simply wait for a bear market? So you're not waiting for a 5% pullback. You want a 20% or more pullback on a monthly closing basis. So what are the odds that you'll get that pullback and it's going to be at a lower price point than today? So I look back historically, not that high. So you're talking about only 20% of the time are you going to get that bear market that's going to bring the market down lower than where it is today. 80% of the time, the market, even after it has that bear market, is going to be higher than where it is today. And if looking at the period since 2009, I think is a good example of this. Let's say you got out in 2008 and you're looking at the market in 2009. It's starting to run up off the lows in March 2009 and run up 7 months in a row off the low in March 2009, 9 months out of 10 months. And you could see where it ends the year in 2009. And let's say at that point in time, you said, I want to wait for a bear market until we get back in because people are talking about a double dip recession. A lot of people have said after that 2009 rally off the lows, well, it's gone up too much too fast. I'll just wait for a 20% pullback on a monthly closing basis. Well, that didn't actually occur until 2022. And you can see when it came, how much higher you were than end of 2009 levels, over 3x higher. So if you were waiting all that period of time for that bear market, it finally came, it's actually much higher. Well, what do you do then? That's a big problem with this type of waiting for a bear market. Even if it comes, it might be higher. So be very careful thinking about this, waiting for the bear market, waiting for a big correction. You have to be prepared ultimately to wait forever because 80% of the time, the market won't give you that opportunity to buy in at a lower level today, even after that bear market comes. Okay, let's talk about dollar cost averaging versus lump sum investing. So up until this point, we've been assuming that you invest everything all at once. So you have that cash sitting on the sidelines and you put it all in today. That's called a lump sum investment. So let's say you have $100,000 sitting in cash on the sidelines. You put it all in today. That's a lump sum. But let's say you don't want to do that. You want to spread it out. You're worried that the bear market is going to start tomorrow. So you don't want to put that $100,000 in all at once today. You want to spread it out over time. Well, that's called dollar cost averaging. And if you split it up, let's say over a 12-month period, what's going to be $8,333 per month. And so you're buying into the stock market in increments over a 12-month period. Well, what are the odds historically that that dollar cost averaging will actually beat the lump sum of putting it all in today? I crunched the data here. Well, you can see in this chart, most of the time, you're going to be above the zero line if you invest in the lump sum. So lump sum is going to beat dollar cost averaging on a 12-month basis. Most of the time, only 33% of the time will that dollar cost averaging beat the lump sum. And the reason for that is pretty simple. Most of the time, the stock market is higher over a 12-month period, and most of the time, it beats an investment in cash over a 12-month period. So sitting in cash and waiting and dollar cost averaging usually is going to underperform that lump sum. Not always. You have about a 1/3 chance, but what if you spread this out even further? Let's say instead of doing it over a 12-month period, you do it over 3 years, so 36 months. Does that help your odds? As it turns out, no, your odds are actually even lower. It moves down to about 26% of the time. And you can see here, you can go very long periods of time, like we've seen over the last decade, where you don't have any period where that 36-month dollar cost averaging beats a lump sum investment, because even when the bear market, let's say in 2022 came, it didn't last long enough for that dollar cost averaging to outperform. So what you really need to see for this longer dollar cost averaging to work is really long-term bear markets that last a few years, like we saw back in 2000 to 2002 and 2007 to 2009. If you don't have that situation, that lump sum is going to win. So that really the odds are stacked against you if you're going to spread it out over time. Let's talk about valuations. It's a big issue today because valuations, you've probably been hearing, have been rising, and there's many ways to look at valuations, but for the purposes of this analysis, I want to look at what a lot of people like to look at, which is called the CAPE ratio, which is simply adjusting earnings over the last 10 years, taking an average and adjusting them for inflation. And what they're doing here is looking at a long-term chart of this CAPE ratio going back to 1900. And you can see the valuation today is pretty elevated, a little bit more than double the historical average. We're about in the 97th percentile if we compare this to the data set going back to 1900. So valuations are high. People are concerned about that because over, let's say, a 10-year period, there tends to be lower future returns when you have higher levels of valuation. So one might ask, well, how would I have done historically if I used this CAPE ratio as an indicator and I got out of the stock market when valuations were very high? Well, let's take a look at a few different systems here. Number one, let's say you moved from stocks to cash when valuations went above the 90th percentile historically and didn't get back into the stock market until the percentile went back below 90th percentile. So how would that have done historically versus a simple buy and hold? Well, you can see here, it actually would have underperformed 9.6% for buy and hold, 8.7% for the valuation timing system. The issue, if you go back in history, is many times you'll see the stock market continue to run up after it hits this 90th percentile. So stretching what you think is possible, an overvalued market becoming even more overvalued. I'm going to come back again to the 1995 example because at that point in time, the stock market goes above the 90th percentile in terms of its CAPE ratio, and it continues to run and run and run higher until it peaks in 2000. You can see here the CAPE ratio ran higher as well. So valuations got more and more expensive, and the stock market is tripling over this period of time on a total return basis. So you have to ask the question, are you going to be able to sit out of the stock market when it triples, when valuations are going up, if you're basing your decision to buy and sell based on value? Most people couldn't sit out a tripling in terms of the stock market, but let's say you could. Let's say you think you're disciplined. Maybe you're saying 90 percentile is not enough. I'm a real value investor. I want to only get back into the stock market when it goes below the 75th percentile. Well, how would that have done historically? Not any better, actually, even a little bit worse. 8.6% annualized return versus 9.6% for buy and hold. So the question, of course, next becomes, well, maybe that's too expensive as well. What about only getting into the market when you're below the 50th percentile? And there the returns get even worse. And the reason for that is you're out of the market for a really long period of time. And the recent history is the perfect example of this. The last time the S&P 500 had a CAPE ratio below the 50th percentile was April 2009. And 1 month later, the stock market was no longer cheap, no longer below the 50th percentile, and they haven't been since that cheap. Now, will they ever get there again? Probably. How long? We'll never know, but stocks are up 9x since that point in time, since the last time we were below that 50th percentile. So the key point that investors should understand is over the long run, returns can still be positive even though they're above historical valuations. And even at the most extreme levels in history, if we're talking about March 2000, if you're looking at long periods, so let's say 20, 25-year periods, the market is still tending to be positive. So even if you did a lump sum at the worst point in history, which would be March 2000 in terms of valuation, the highest valuation we've ever seen, if you look at where you are today, you're still up over 500% on a cumulative basis had you held on. Now, was there a bad period of stocks following that valuation peak? For sure. There was a 10-year period where the S&P essentially did nothing. But if you stretch that out and you held on and you kept buying in terms of adding to your 401k and IRA, you would have done very well. And again, worst point in history on a valuation basis, you're still up over 500%. And the reason for that is the market eventually grew into that valuation by providing higher levels of earnings. Nobody can predict where valuations are going to be in the future. The likelihood is likely that they will be lower just based on mean reversion, but we can't say how much lower, and we also can't say when they're going to be lower. So for an investor, just looking at valuation and trying to time your exposure to the market based on that one factor, very difficult thing to do. Okay, recessions. Is a recession coming? Yes. When is it coming? We don't know. Why do investors want to get out of the market before recessions? Because the stock market tends to have a worse bear market during a recession. If you look historically, the average decline for the S&P 500 during a bear market is about 35% if we include everything. But if there's a recession, it tends to be much worse. So bear markets associated with recessions down 42% on average. No recession, 28%. So much milder. So wouldn't you want to avoid that type of sharp decline? Of course you would. But first you got to ask the question, does the stock market always have a bear market during a recession? The surprising answer is no. You're probably surprised because we haven't seen this in a while. Most of the recent recessions, all of them since 1980, have had a 20% or more decline, but there's a few in history that we should look at here that did not. So 1980, 17% decline, 1953, 54, and 1960, 61 recessions had only a 14% decline in the S&P 500. In 1945, there was an 8-month recession with no major decline to speak of. But let's say you're assuming it's going to be more like these other periods where you have a recession and you have a big stock market decline and you want to avoid that. Well, what if you were the world's greatest economist? You were able to get out of the stock market exactly when a recession began, and you only got back into the stock market when the recession was over. You were able to predict with 100% accuracy when the recession would start, when it would end. Of course, this is impossible. Let's assume, for the sake of analysis here, that you were able to do that. How would you have fared versus simply riding it out, simple buy and hold? So what we see here is you actually would have outperformed 10.5% per year versus 9.6% for buy and hold. But this is including the Great Depression. So if you dig into the data, what you'll find is if you exclude the Depression, your actual returns would have been worse than buy and hold. 10.4% for getting in and out of the recessions precisely versus 11.5% for buy and hold. And the reason for this is that the Great Depression stock market decline was so huge that avoiding that really helped that timing return. So you had an over 80% decline in the stock market during the Great Depression, which led to that higher return. So realistically, though, There is no world's greatest economist. Realistically, you likely wouldn't have perfect timing. So let's say you sold 1 year before the start of a recession and bought 1 year after, or sold 6 months after the start of a recession and bought back in 1 year after. Your returns, you can see here, lower than buy and hold in all these cases. And again, this is not including transaction costs, taxes, slippage, all of that. And if you included that stuff, the differential versus buy and hold is going to be much, much worse. So very difficult to time your exposure to the stock market based on the economy. Even if you knew what the economy was going to do, it would be very, very difficult. And the reason for that is the stock market is not the economy. The stock market is a different animal. The stock market is a leading indicator, often moves well before the economy moves. So when the recession is ending, the stock market is often running up well in advance of the end of that. And we can see by the time there's an announcement that the recession has ended, it's often way too late to jump back into the market. And just looked at the past few recessions, and NBER is the organization in the US that is the official arbiter saying when a recession starts, when it ends. But you could see by the time they come in and say that the recession is over, the S&P 500 is often well above its low. And we saw in 2020, they didn't announce the end of that recession until July 2021. 15 months later, the S&P 500 is already up 94%. So as Warren Buffett said back in October 2008, if you wait for the robins, spring will be over. If you wait for things to be rosy and the official end of recession, well, the market's already going to run up. You don't have that. You don't have that lower valuation to buy into. You don't have that discount. You don't have that same opportunity. Don't wait for the robins to get invested. When you have a huge stock market decline, that's often a gift for long-term investors to buy in at lower prices, with the prospective returns often being much better because you have lower valuations. Okay, number 7 here, interest rates. This is something that's been a big topic in the last few years because we saw interest rates hit record lows in 2020, and then we saw a big spike in interest rates during 2022. You can see here one of the biggest moves ever in the 10-year Treasury yield. It went from 1.52% at the start of 2022 to 3.88% at the end. That was one of the biggest declines biggest increases in the 10-year yield that we've ever seen in history. And the stock market went down a good amount in 2022. It was the worst year for the S&P 500 since 2008. So many investors that year really said, well, higher interest rates seem to be bad for the stock market, and there's a real inverse correlation going on here that higher rates always will be bad for the stock markets, lower rates good for the stock market. That seems to be the perception, but it's interesting because if you look at the actual data and you run a correlation, the correlation is actually close to zero. So really no predictive power whatsoever. If you tell me where the 10-year Treasury yield is going to be a year from now, I can't tell you what the stock market's going to do because that correlation is zero. And the historical data really backs that up. If we look at what the S&P 500 has done on a 1-year period on average, when the 10-year has been higher, it's 11.5% on average return, and when the 10-year yield has been lower, 11.5%, exactly the same higher or lower interest rates historically. And yes, 2022 was a bad year for stocks, and yes, interest rates were on the rise that year. But if we look back at history, there's been other years where interest rates have risen a great deal, and the stock market has had a very high return. So simply just looking at interest rates and just saying interest rates are higher, not enough to tell you what the stock market is going to do. And oftentimes, higher interest rates can mean a good thing. It can mean more economic growth, higher profits, which is good for the stock market. Now, what about interest rates rising over a long period of time? Does that mean you're going to have a period of lower returns? Not necessarily. We have this great example here from 1949 to 1968. The 10-year Treasury yield went from 2.3% to over 6%. The S&P 500 during this period of time actually had a return of greater than 1,500% cumulatively, 14.9% per year annual return. So just because interest rates are rising doesn't mean it has to be bad for the stock market. Not a good idea to make a decision on what to do with your investment based on the direction of interest rates. So, what have we learned about investing cash on the sidelines today? Well, first, we learned it's not easy. There's no 100% solution, there's no 100% right answer. Investing is all about probabilities, never certainties. And the probabilities suggest that if you're sitting in cash, you're going to lag the stock market. The longer you sit in cash, the higher that probability of lagging an investment in stocks is going to be. But still, it's not an easy decision because we're human beings. We have emotions, we have fear, we have greed, we have regret. So you really have to find the solution that allows you to sleep at night. So if you're investing 100% today because that's the highest probability outcome, but you can't sleep at night, that's probably not the right answer for you. You have to find the solution that you can stick with. For everyone, there's a different path, but there is a path for everyone to be an investor if you have this long time horizon and you can stick with it. So in terms of building a portfolio, today we were just talking about the S&P 500 for simplicity, but in reality, that's not going to meet everyone's needs. There's likely going to be other things in your portfolio to balance out the risk in stocks, other things in your portfolio. So it's not just the US, you're going to have international, you might have value stocks, you might have small caps, private investments as well. For everybody, the answer is different. But what I want you to think about and remember here is this chart right here. If you have that long period of time, an investment in something like the stock market, which has a higher long-term growth rate, is going to likely leave you with much more after a 10-year, 20-year, 30-year period than just sitting in cash. And so find that way, find that path for you so you can reap the enormous long-term benefits of compounding. If you're watching this and you're in this situation today, reach out to us at creativeplanning.com/Charlie and get a free wealth path analysis. We'll take a look at your cash position. We'll take a look at your existing portfolio. We'll help you make this decision at Creative Planning. We're at all 50 states, so we likely have a location right near you, over 325 billion in assets under management and advisement, and we're here to help. So reach out today, creativeplanning.com/Charlie. If you're watching this on YouTube, subscribe to the channel, and I'll see you next time. Thank you so much for joining.